Hi there, my name is Gary Munson, one of the founders of Main Street Alternative Asset Planners. Wanted to pull back the curtain just a little bit and give you a peek behind and see what it looks like for our clients when we create for them a personal alternative asset plan, a portfolio. Do you want to take a peek? And let me tell you why you want to listen, because right now I speak to so many people who are tired of the Wall Street casino. They're seeing that the risk just isn't worth the reward any longer. They're telling me, hey, they want control of their assets because no one cares more about their money than them. They're telling me they want tangible assets. They're tired of this paper ownership of their retirement and assets that are subject to crazy market fluctuations and losses caused by wild things that go on in Europe. Well, we want assets that clients understand. They want risks that they understand. I haven't yet talked to a client that understands what a mutual fund does or what an EFT does and what the risks are there. And they all want better, more solid returns. And that's what we're here to provide. Also, the assets that we provide give cash flow, which is just the thing that makes it so we can actually retire. So why do you want to listen to us? We know what we're doing. We've moved over $2 billion away from Wall Street investments into Main Street type of investments. We've been doing this for over 12 years. We've got over 5,000 happy clients to tell you about it, and we've been quoted many times in the financial press. My partners have been quoted in the Wall Street Journal, in the Business Week, in Forbes, in Kiplinger's. Hey, we know what we're doing. Well, the first thing we do when we sit down with the client is we go through an asset allocation guide because we need to establish what the risk tolerance is. We're going to talk about things like time horizon, how long till you need your money, what do your financial goals look like, and then how do you feel about money being lost, or how do you feel about putting money at risk? And we get a total score. Now, when we have a total score, it brings the score into a basket allocation. We're going to put eggs in many different kinds of baskets away from Wall Street. And so this is one of our basket allocations. This one suggests 35% of the dollars should go to real estate investments, 20% in non-recourse lending, which is loans that banks would have normally be taking, 10% into structured settlements, 25% into pooled funds, and then 10% into precious metals. And we'll talk about each one of those. But as we talk to this particular client reallocated that just a little bit to things that she felt more comfortable with. So she settled on 45% to higher return rental real estate, 25% to trust deeds or private mortgage lending, 30% to pooled funds, and then she decided that she wanted to have a golden goose rather than just buying the golden egg, and so she decided to use her precious metals allocation to go buy something that creates cash flow every month, and then use the earnings to go buy precious metals. And so we've got an asset class summary here. At the bottom, it gives a legend of excellent, 4 stars down to fair for the kind of asset class, and the 5 things we should be concerned about in our retirement accounts. 1, real estate returns. 2, does it cash flow? 3, does it stay ahead of inflation? 4, does it secure our principal? And then 5, a consideration is liquidity. Can we convert our investment to cash, and how fast? And so then it goes down and covers each of these asset classes with some common ones. A lot of this money right now that we're moving is sitting in CDs in the bank. And so everyone knows what the returns look like in a CD, what the cash flow is like, what it does against inflation, which isn't good, but it is very secure and it is very liquid. Well, mutual funds, a little better on the returns, not so good on the cash flow. Okay against inflation. The principal is not secure, and it is fairly liquid. So then we can take a look and help the client, come to a feeling of confidence and peace about where they want to put the dollars. Then we go back to work and we come back with some assets for their consideration. We've got a couple of different real estate vendors that bring us properties. Okay, this particular vendor likes condos that are in Florida. These are properties that have been taken back from a bank, and a developer couldn't finish out a condo complex. And so they go in and buy the existing units, the ones that didn't get finished, and then finish them out brand new. They turn and sell these condos to our clients. These are properties with higher appreciation potential because they cost a lot less than a light condo that's down the street that they have to build all brand new right now. And these clients can purchase these condos with 50% down. Generally, the rates of return on these things net after paying for the taxes, the insurance, the property managers that take care of it, and taking care of the homeowners association dues, they still net in the 10 to 14% range. Not bad returns. Way better than the 1%, 1 to 1.5% people are getting in the CDs of the bank or in a money market account. We have another vendor that provides real estate homes for us that are existing. They're a little bit older. But this supplier watches and carefully selects the markets where they purchase homes. They don't want to go to a place like Las Vegas or Detroit where it's all driven on one economy that can get knocked back off. They go in a place where there's 4 or 5 or 6 different places, different economies, for the renters for our properties to have a job. After they pick a market, they go in and they buy some homes from foreclosure sales. They rehab them and they go ahead and put a tenant in place with a long-term rent, long-term lease, 1 to 2 years long, and then they have a property manager to take care of the heavy lifting on the property, the day-to-day, this is leaking or this isn't working, and these properties are also provided at a 50% down payment, higher net returns on these things. Here's an example. This particular client, we suggested that she take this one. This is from St. Louis, Missouri. Here's a property. It's $45,000. If the client purchased it outright, after paying the taxes and the insurance and the management fee, that $750 rent nets out to about almost $9,000 a year. The total costs for this thing, about $2,200 a year, so that leaves a net of $6,700 on that $44,000 investment, almost $45,000. And if they purchased it outright, that's about a 15% rate of return. Very solid. Or if we did some non-recourse lending and we used leverage, we could purchase this property with almost $25,000 down. We could get $20,000 of that financed. That interest rate is 8% or about $1,600, but still the net return is $5,100 after paying the taxes, the insurance, the management fee, and the mortgage. I'm still making $5,100 on my $25,000 purchase price or my purchase money. So I'm getting a cash-on-cash return on that one of 20.7%. Another property in the St. Louis area we selected for this client, great property manager that's going to take care of it. Same type of thing, $48,000. If she purchases it outright, it's 15.3%. Or if we do the financing, and when we're using retirement dollars, we have to use non-recourse lending, and we have that kind of lending here that we can take care of it. There's no qualifying; it's just based on the property itself, and that's a return of 22.1%. Really nice. So here's kind of a summary sheet of the client, assuming that they use the leverage. 20.7 on Fifth and 22% on St. Stephen's. Combine them together, $50,000, almost $51,000, brings an annual return of almost $11,000 or about 21.4% for that real estate portion of her portfolio. We've also suggested that the client, step in and do some lending for some of our other clients. They kind of play the role of the bank. These kind of loans pay a net of about 9%. 8% comes in monthly. A client comes in with half of the purchase price, and they're very happy to buy these properties because if they've got a non-recourse lender, it ups their returns significantly. And so they're very happy and anxious to buy this home. And they, of course, go and vet it out, make sure it's a property they want to have. Well, our clients extend a 5-year loan to these clients, to these buyers of the home, and they get 8% interest only on their note. And so every month there's that money coming in, and then at the end of 5 years, the lender has a conversation with the buyer, and they decide if they want to extend that note and do it again. Hey, if inflation's gone crazy and CDs at the bank are paying 12 right then don't renew the note. Get paid off and go invest in a CD at the bank. But if it doesn't, if things are still dreary, like 1% right now, stay with the lending. Now, our clients buy these notes at a discount, at a 5% discount, meaning if the note was for $20,000, our clients only paid $19,000. Of course, the interest is paid on the $20,000, and at the end of 5 years, they get that discount back because that $20,000 note has to be paid off at $20,000. So that provides an extra $1,000, and that's what takes an 8% note up to a 9% return. Okay, it's a nice way to go. Of course, we have an assignment of rents assigned for the lender. The lender is protected with some homeowners insurance. So if there's damage to the property, our client, who's the lender, gets paid off. And then if for some weird reason that there's a default on this property, and I don't believe the buyer of the home would ever default because they've got 50% of the purchase price in the game, they got a lot of skin there, but if they let it go, we've got a very simplified process to turn the ownership over to the lender. And if that's the case, man, the net return on this one, if the lender continues to just rent the property out, the cash on cash there is about 39%. It almost makes you wonder if default's a bad thing in this situation. Or of course, the lender could turn and sell that at a significant profit and still sell it well below the market price. Maybe they sell it for $37,000 and pick up an extra $18,000 on that. So this is one of my favorite kind of situations, a non-recourse loan. Here's another one, same situation, 9% rate of return, 5-year agreement, very high returns if there was a default. And we've also got some pooled funds in lending for our clients. And this particular client chose this particular fund where if she put in $40,000, it's pooled with a great great real estate lender. He's in Austin, Texas. He loans a 300-mile radius around Austin, Texas. They'll go in and they'll lend on commercial projects at about half of the real value. And they loan it at higher returns because these people can't get bank loans. And so if the fund has to take back that property because the payment goes into default, the property is sold, the fund is repaid, more money than they lent out, and they're in pretty good shape. This particular fund, it's a return range anywhere from 4 to 10%. This particular fund manager personally guarantees principal and interest into the fund. He's an ethics professor at a well-known university, this is a pretty safe investment. We like it a lot. In fact, the ownership in this situation is an LLC. And so what that means is if there's a profit in the fund, in the company, then it has to be distributed out to the LLC owners. And so last year there was a 4% bonus to everybody just based on how the fund did for the year. That's a bonus, but the rates of return are anywhere from 4 to 8 before bonuses, if that happens. And we shouldn't plan on there being a bonus, but it could happen. Hey, here's another fund that we really like. This group works with new government contractors. The federal government issues $1 billion of new contracts to business every single day. And there's rules that don't allow the big, Fortune 500 companies to come in and take all these contracts. And so they like small businesses. There's certain contracts set for small businesses. Certain of them want minority-owned or women-owned businesses to be the ones that earn these contracts. And so this company goes out and helps these new companies, these new smaller companies, go get government contracts secured. They help them with the bid process. They help them with the bonds to get set up and going. And then after the contract starts going and the company starts providing services to the government has quite a delay of when they pay. And so the fund lends money to the company while they're waiting for the payments to start coming from the government. This company that we lend to owns 51% of the contract. And so if the contractor falls down, they can reassign it to someone else. Pretty good return. This one requires $50,000 minimum, pays very good returns at 17.4. This is a 2-year agreement. So it's a nice situation for people. Hey, we've got another one, $50,000 minimum. This one earns 14%. This is people who have gone out and have been suing a major company, maybe like that lady who got burned on the hot coffee at McDonald's. McDonald's settled with her to get the suit done. This company goes and finds people who have lawsuits dragging along with corporate America and helps them, pays them money up front, kind of lends them money so they can hold on and wait and get the maximum settlement coming from these big companies. And these individuals are more than happy to pay back a portion of the settlement so they can go on and get the maximum. And this is a 5-year agreement, and this company goes out and finds these people to lend to. And the company's had success about 95% of the time. Does really well. The way this one's paid out is it's paid out 10% monthly for 60 months. And then at the end of 60 months, there's a bonus of 20% of the principal paid at that time, which ends up being an extra 4% every year. So over the 5 years, it averages at 14%. Nice situation, nice place. We've got another situation that it is involved in casino gaming. We've got a company that goes in and works with the casinos, and when we've got video poker games on the floor that aren't doing well, the casinos want to change that out. And so to go buy a new video poker game, it costs about $20,000 to $25,000. This company goes in and refurbishes an existing cabinet and just puts new guts in the game. It allows them to do this for about $6,000 instead of $20,000 to $25,000, so the casinos love that. And then if they needed to upgrade or update a game going forward, it's simply plugging in the thumb drive and updating the game. The casinos pay out to this company $14.50 a day per table, or per video poker machine that they've got going. And so this pays great returns back to the company. This requires a $5,000 minimum. The first year return is about 11%, and it increases every year as it moves forward. This company's already got an agreement with the biggest casino company in Nevada, and they're starting to install, and they're just rolling this out. If it goes over time, the average over 10 years on this one ends up being about 35%. This is a 2-year minimum agreement, so good stuff there. I've got one last fund that we really like. It's a commercial mortgage fund. It's again $50,000 is the minimum, and it's a 5-year agreement. But they lend on interesting commercial properties. Like, I don't know if you've ever seen a Rowley's Drive-In. It's really small. You can't go inside. They have a hard time getting bank financing, but they'll come in and pay higher returns because their businesses make great money. So these guys will loan on a Rowley's maybe 50% of the value of the property. If it goes bad and they have to sell the property, this particular fund will split the profits back to the people who have lent money to them 50-50. So the fund keeps 50% and 50% is paid out. This is a 5-year agreement. It earns 12% rate of return with that 10% paid out monthly. Really nice way to take advantage of it. So one of the things that we can do is we help people is we have what's called a managed account. In the managed account, we'll take care of correct tax reporting. As we've seen these accounts established over the last 12 years, we've had about 5,000 people do it. We see it over and over, people continue to struggle with certain things. And so we will do the managed account for them and keep the tenants in place, take care of all the compliance, make sure the tax reporting is correct, and help reinvest the cash that's accumulating, because these particular investments bring monthly cash flow. At the end of the year, we'll help them rebalance to keep those basket allocations the way it was chosen. And we'll do the custodial management, take care of the daily minutia that they try and hammer us with. So why do we want to use this managed account? Because if someone messes up with a self-directed IRA, the penalties start at 10% of the entire balance, and the IRS doesn't care if it's an innocent mistake. And some of the mistakes we see, someone making a new contribution into the account without sending it to the custodian, they just send it right to the bank where their checkbook is, or something called self-dealing, which is allowing you or a direct ascendant or descendant to benefit from an IRA investment. So if you stayed in a vacation condo that your IRA owns, that would cause it. If you rented an IRA-owned property to a grandchild, or if you sell your IRA-owned property and you're a real estate agent and you keep the commission. These are common challenges. And we, of course, can, we'll take care of it and make sure you avoid all these things. The charge is 0.25% of the account balance quarterly, probably less than what you're paying right now wherever your money is. Well, here's kind of what a summary would look like as we worked for this particular client. We had $50,000. We look to the top right that we purchased those 2 properties for her in St. Louis. The rate of return on that cash was 21%. And then we put some money in one of the real estate funds. She did $40,000. That guaranteed return was 8%, or $3,200 coming out of that a year. Then she bought those 2 notes on those properties, and that generated another about $3,000. So $6,400 from lending And so as we take a look at all of this, and we saw that we were using about $126,000 for her, the returns on our personal portfolio for her about $17,000, or about 13.7. These are assets that she owns, that hold values, not paper stuff. And then you can look down at the bottom and see the difference between just an accumulating account, which is on the left, or the managed account, even deducting out the fees and expenses. It ends up over 10 years about another $100,000. So that's kind of what it looks like. Does it seem interesting? If it is, please click on the button below and we'll gain access behind the curtain instead of just a peek. We won't even ask you for your email address, but we'd love to help you learn more about this if it's something that's interesting to you. Thanks very much.